Alright guys, welcome to another video. Mr. J here. So glad to have you guys in this video. So in today's video we'll be talking about a very important mistake most traders make that you need to avoid. A very important mistake that you should avoid when it comes to trading. Yeah, so basically, as you all know, we have the basic market structure, which is the uptrend, the downtrend, and then the ranging market. This right here is the basic market structure, which everyone knows, right? And then we established that from our former videos, we know that uptrend consists of what breaks of structure, which is what lower low and then higher highs, lower low and higher highs. This is a typical example of a uptrend, right? And then a downtrend consists of the lower highs and then the lower lows, right? And then of course we're having breaks of structures indicating that we're in a downtrend. And then when the market is ranging, we're basically not having any market direction. We're just stuck in a trend. The market is just moving up, down, up, down, up, down. No clear direction. So in this scenario, we want to be avoiding this kind of structure, right? Now, when you want to make your entries, when you're making your entries or looking for your trades, right? This is what you should focus on, right? So now from this examples over here of basic market structure, we understand that market forms lower lows, higher highs, lower lows, higher highs, right? And now each of these lower lows is breaking structure to the upside, right? So each of these lower lows is breaking a structure up to the upside to create what? To create a higher high, indicating that okay, the trend is what continuing. So we want to be trading the in line with the trend, of course, as you all know. Now, the best time to be looking for entries is not from this zone, these zones over here, right? Because as you can see now, this is a low. Market started creating little internal structures. All these are all internal structures. The market is forming these internal structures, going up, going up. So you can see over here, we have a sweep of liquidity over here. Market break structure over here, right? And then finally takes out this external high, right? This lower low created. You can see this lower low created this external high, right? So basically, as you can see, this lower low now took out this higher high, right? So now the ideal thing is that we can see this over here as a structure, as a break of structure, liquidity. Those people that trade smart money concepts understand me better. So this is a break of, this is a sweep of liquidity here, a break of structure to the upside. Then we have our liquidity, and then our POI is resting below here. Now the idea is that the market will come back, take out this POI, and then tap into this demand zone over here, and then we'll now continue the buy to the upside. That is the idea, right? But that's not what we want to be looking out for, because we want to be very careful. We want to be entering this market if it comes back to this low, this lower low over here, right? Now this lower low over here will be our entry. We are not interested in anything that happens over here. This is the last low that broke above this high. This is not the last structure that broke above this high rather, sorry. So you see, so this is the last low that took out this high. This is where the wave started from. This is the beginning of the trend that took out this high. This all here is just, it will serve as an inducement, right? Market would likely come back, will take out these people, that anyone that enters here will just become liquidity. That's why you see market will sometimes come back with this POI, buy a little bit, and then take out the stop losses and then target the extreme low. So it's very important to understand that the best places to be looking for your entries is where are these lower lows, right? At this lower low. So now, like I said over here, so focus on the lower lows. This is the lower low that created what? The new high. That is where our focus should be on. So the lower low that created what? The new high that broke the structure to the upside. So in a bullish scenario, we want to be focusing on the lower lows. That's the demands on the lower lows. That's where we want to be taking our buys from. While in the bearish scenario, is just vice versa, the same thing. I give an example here. So you can see we have lower highs, lower highs, lower highs. Each of these lower highs are breaking what? Structures to the downside. As you can see, break of structure here, break of structure here, and that break of structure here. Now, the idea is that we want to be, hope you can see this, the idea is that we want to be entering from where this lower highs, focus on the lower highs, right? This lower highs. Now there's, at every high there is supply, and at every low we have a demand. At every high we have a supply, and every low we have what? A demand, right? So as you can see over here, we have a break of structure over here. This wave breaks this structure over here, then gives us a look at it, comes back to give us a nice what's it called, internal liquidity over here, right, before finally taking out this low. But we are not interested in selling from this POI over here. This supply here over here is a valid supply, because but all these are all internal structures, right? So you want to be focusing on this market to come back to this extreme high over here, because this is the high that broke this structure. That is where you want to be focusing on. So you focus on the lower highs, the supplies at the lower highs. But when market comes to that supply on the lower high, then based on your strategy, your confirmation strategy, whatever you use, you can now be looking for ways to place your trade and sell to the downside, right? So guys, I hope this helped you. That'll be all for today, and I'll see you in the next video. Peace.